Hey everyone, and welcome back to the Deep Dive. Today we're really jumping into something big,
Mhm.
understanding and maybe even mastering what people call the game
Mhm.
of money. We've gathered a lot of great material, including a pretty comprehensive guide that unpacks strategies, mindset, everything you need for, well, real financial freedom.
Yeah.
And it's definitely not just about the numbers. It's more about changing how you think about wealth.
Exactly. And what's really interesting is how the sources we looked at, they challenge some very common ideas that honestly can hold people back. So many people feel overwhelmed by investing in money stuff. We're going to try and break down some of those myths that really stop investors from actually reaching their goals.
And some of these myths, wow, they can cost you dearly, can't they? Like one statistic really jumped out at me from the research. Did you know the average mutual fund might be like eating up 50% to 70% of your potential returns over time? How is that even possible?
It's pretty staggering when you look at the actual breakdown. Our sources show the total cost can hit around 3.17% a year. That's not just the expense ratio they tell you about. It includes hidden stuff like transaction costs, even cash drag, that's money just sitting there, not invested, over, decades. That adds up. It's a massive bite out of what you could have heard
A
of.
massive bite. And it sounds like most people have no idea. I saw that figure too. 67% of people with 401ks think there are no fees at all.
Have a
That's a
birthday.
problem. What's the main reason for that, do you think, that big gap in understanding?
Well, a big part of it is how returns get advertised. Funds often talk about time-weighted returns, like basically assumes your money was in from day one and never moved. But that's not how real people invest, right? You put money in, maybe take some out, invest here and there. That actual behavior, what you actually experience, leads to what's called investor-weighted returns. And they're often much lower, partly because, people tend to buy high and sell low, driven by fear or excitement.
Ah, okay. So the numbers they show aren't really what you experience. And it's not just the fees hiding, is it? Our sources also made a really critical point about getting financial advice. Like, most brokers aren't actually required to put your interests first.
That's absolutely right. And this is really crucial for you listening. It can be a total game changer. See, a broker usually works under what's called a suitability standard. They just need to recommend something suitable. But they might get paid more for selling product A versus product B, even if B is better for you. That's a conflict of interest right there. A fiduciary, on the other hand, has a legal duty, an ethical obligation to act only in your best interest, period. Your needs come first. That's the fiduciary standard.
That difference sounds huge.
Yeah.
So for someone listening, trying to figure this out, how do you make sure you're dealing with a fiduciary? Like, what should you ask? What signs should you look for?
Yeah, good question. The simplest thing is just to ask directly, are you a fiduciary? Look for certifications, maybe like Certified Financial Planner or CFP, though you still need to ask because not all CFPs act as fiduciaries all the time. They should be totally upfront about all fees, not just commissions. Maybe they charge a flat fee or a percentage of assets. That's usually better than commissions tied to specific products. A real fiduciary puts you first. It's the law, and it's their principle.
Okay, that's super practical advice. Thanks. So we know the pitfalls. What about the good stuff? The forces we can use to our advantage. Compounding comes up again and again in our sources. Einstein called it the eighth wonder of the world. Can you break down what compounding really means for us?
Sure. Think of it like a snowball rolling down a hill. You start small. That's your initial investment. As it rolls, it picks up more snow. Those are your returns, your interest. But here's the kicker. The snow already on the snowball starts picking up more snow, too. So your earnings start earning their own earnings. The growth builds on itself, and it actually speeds up over time. It's growth on your growth.
And the stories about this, they're really something. Like Theodore Johnson worked at UPS, never made more than $14,000 a year, apparently. But he ended up with over $70 million.
Oh.
He just saved 20% of every paycheck, every bonus, and invested mostly in UPS stock. He just kept paying his freedom fund first, as they put it. It's kind of mind-blowing.
It really is. That simple, disciplined habit, plus that compounding magic over decades, it just creates this incredible outcome. And it connects right into figuring out the real price of your dreams. Whether you want basic security or independence or total freedom, the sources suggest the actual number might be way less than you think.
Right, like that example of Angela. She thought she needed, $3 million for security, but then she actually calculated her yearly expenses and realized her security number, just enough to live on without working, was under a quarter of that. Suddenly needed only about $34,000 a year for basics. It made freedom seem, reachable for her, not some crazy fantasy.
Exactly. And that really brings up a question for you, the listener. What's your number? Once you figure that out, the whole game of money starts to feel winnable. And to help you win, we're going to dive into what the sources call the billionaire's playbook. Insights from some truly legendary financial minds.
Okay, billionaire's playbook. I like the sound of that. When you talk simplicity and low cost, Jack Bogle, the Vanguard founder, has to be top of the list, right? What was his big takeaway?
Oh, absolutely. Bogle was, well, relentless about low-cost index funds. He pointed out that something like 96% of active managers, the folks trying to pick winning stocks, they just don't beat the overall market in the long run. A huge reason, fees. Their fees, averaging maybe 2% all in, just eat away at returns. His whole philosophy was basically common sense. Just buy the whole market cheap with an index fund. Forget the fancy, expensive strategies.
Simple common sense beats complexity.
I like it.
And it's kind of funny, isn't it?
Yeah.
Even Warren Buffett, maybe the most famous stock picker ever, basically agrees with Bogle for most people.
Yeah, it's surprising, but true. Buffett recommends a super simple mix for most people saving long-term. 90% in a really cheap S&P 500 index fund and 10% in short-term government bonds. He even bet $1 million, a famous bet, that hedge funds couldn't beat a simple S&P index fund over 10 years. Guess what? By 2014, the index fund was up way more, like 43.8%, while the hedge funds were only up about 12.5%. It just speaks volumes, you know? Simplicity and low costs win for most of us.
Wow. Okay. Winning $1 million bet with an index fund, that proves a point. Now let's maybe shift gears a bit. Managing risk, especially when markets go crazy. Ray Dalio's all-weather portfolio is famous for handling downturns. Like 2008, the market crashed, 37%? His portfolio was down less than 4%. How does he do that?
Dalio's approach is, well, it's brilliant because it's not about predicting the future. It's about preparing for whatever might happen. He sees the economy having different seasons, like times of rising inflation or falling inflation, rising growth, falling growth. 4 basic states. Instead of guessing which season is coming, he builds a portfolio that has something that should do okay in each season. It's not just about diversifying across stocks and bonds, it's about diversifying your risk across different economic conditions. So no matter what the weather, you're sort of balanced.
Diversifying risk across economic seasons. Yeah, that's a neat way to think about it. Makes sense. Okay, another legend, Paul Tudor Jones. Amazing track record, right? 28 profitable years in a row. What's his secret sauce?
Jones is fascinating. He boils his success down to really 2 things. First, he's absolutely obsessed with not losing money. He literally says he thinks more about losing than making money. Defense first. Second, he hunts for what he calls asymmetric risk-reward. Think of it like this.
Yeah.
You make a bet. If you're wrong, you lose $1, let's say, a small known amount. But if you're right, you stand to make $5 or 10 or way more. Huge potential upside, small potential downside. He actually said he could be wrong 80% of the time and still not lose if his risk control is tight. It's all about finding those lopsided opportunities.
Risk 1 to make 5. I get that. Play where the odds are stacked in your favor if you win. What about Carl Icahn? The sources call him the most feared man on Wall Street, but his results are incredible, even better than Buffett's over some periods. How does he operate?
Icahn is different. He's all about finding companies that are seriously undervalued, companies where the assets are worth way more than the stock price suggests. And like Jones, he's looking for that asymmetric risk reward. But he's also an activist. He buys a big chunk of the company and then, well, he pushes hard for changes to unlock that hidden value. He's a long-term guy too, sometimes holding things for decades, waiting for the real value to show, not worried about daily market swings.
So finding value and then actively making it happen. Okay.
Yeah.
And Charles Schwab, he totally changed the game for regular investors, didn't he?
Oh, absolutely. Schwab's big thing was putting the client first. He did that by slashing commissions, making investing way cheaper and more accessible for everyday people. He really pushed diversification using those low-cost index funds and ETFs we talked about. Basically, he made the Bogle-Buffett approach easy for anyone to do. He democratized investing, really.
Made it available to everyone.
Got it.
And lastly, Mary Callahan Erdos. She runs, trillions at JP Morgan Asset Management. Any key insights from her perspective?
Erdos brings a sort of institutional view, but with practical advice. She agrees active management can work, but maybe more for the really sophisticated players. For most people, invest for the long haul. And, crucially, only take money out when you absolutely have to. She really stresses having a well-diversified portfolio and just having the discipline to stick with it, even when the market gets choppy.
Stay the course. Makes sense. Okay, so we've covered a lot of mechanics, strategies, but the sources also stress something else. Psychology. They say success is like 80% psychology, only 20% mechanics. What does that actually mean for us and our money?
It's a huge point. It means you can know all the right things to do, avoid high fees, use compounding, diversify, but you can still sabotage yourself because of the stories you believe about money, like, I'm not good with numbers, or rich people are greedy, or it's impossible for me. Your emotions, fear, greed, anxiety, they have a massive impact on your financial decisions. Fear makes you sell low, greed makes you chase hot stocks, that kind of thing.
Right. And the sources talk about core human needs, like the need for certainty. And how does that need for certainty mess with our financial decisions? Does it make us too cautious, maybe?
That's a great point. Yeah, that drive for certainty. It makes the inherent uncertainty of investing feel really uncomfortable. So what do people do? They might keep way too much cash just sitting in a savings account, earning almost nothing, maybe even losing value to inflation. Or they just avoid the stock market entirely because it feels too risky. They miss out on decades of potential growth. We crave safety, naturally. But in finance, sometimes what feels safest in the short run actually holds you back the most in the long run.
Huh. That really shifts perspective on risk. Feels safe, but isn't really safe long term. The sources also list those 6 basic human needs: certainty, uncertainty of variety, significance, connection, love, growth, and contribution. And they say true fulfillment really comes from the last 2, growth and contribution.
Yeah, and that's where it gets really profound, I think, this idea that the real secret to living is giving. So mastering money isn't just about piling it up for yourself. It's about what that wealth allows you to do. It enables growth learning, experiencing, and it enables contribution, helping others, supporting causes, making an impact beyond yourself. It kind of reframes the whole goal, doesn't it? From just getting stuff to actually making a difference.
Or acquisition to impact. I like that. Okay, looking ahead. This gets really wild. We've talked about current strategies, but what about these crazy new technologies like 3D printing organs, advances in health? How could that stuff actually change our financial planning? Could it change what retirement or even wealth means?
Oh, it absolutely could. Just think about it for a second. Scientists using 3D printing to make new organs from your own cells. That could mean much longer, healthier lives. Things like vertical farming or lab-grown meat that could make food incredibly cheap and abundant. These aren't just cool gadgets. They could solve fundamental scarcity problems: water, food, health, maybe even housing. And if those basic scarcities disappear, well, our sources suggest the definition of wealth itself might shift dramatically. Maybe your financial goals become less about hoarding scarce resources and more about, what experiences you want, what impact you want to have in a world where basic needs are easily met.
Wow. A future of abundance changing the very definition of wealth. That's a lot to think about. So wrapping this deep dive up, what's the big takeaway for you listening? We've definitely journeyed through some complex money stuff, right? We busted some myths that cost people real money. We looked at strategies from absolute giants in finance. You've hopefully seen how simple things like automating savings, cutting fees can make a huge difference over time, and how understanding ideas like asset allocation can give you maybe some peace of mind. Whatever the market's doing, the game is winnable. And maybe, just maybe, the deepest meaning comes not from what you get, but from what you give back.
Yeah, this has really been about giving you the knowledge, the tools, so you can take control of your financial life, starting right now. But here's that final thought, something for you to chew on after this. If these new technologies really are starting to solve age-old problems of scarcity, food, water, maybe even extending life itself, how is our relationship with money going to change? How will your definition of financial freedom evolve? And maybe more importantly, in a world where abundance looks totally different, what's going to be the most valuable contribution you choose to make?